Welcome to this webcast introducing IFRS 18, the forthcoming IFRS accounting standard for presentation and disclosure in financial statements. I'm Nick Barlow, and I'm joined by Juliana Rebecca Oatmeyer.
Hello.
To start us off, Juliana, would you please share with us the helicopter view of how IFRS 18 will improve financial reporting and provide better information for better decisions?
IFRS 18 arises from the ISB's work on the primary financial statements project in response to investors' demand for better information about companies' financial performance. It will improve how information is communicated in financial statements and give investors a better basis for analyzing and comparing companies' performance. IFRS 18 will affect all stakeholders in the IFRS accounting standards ecosystem. So that our listeners can understand the likely impact of IFRS 18, Nick, can you share with us the key requirements that will be introduced by IFRS 18?
Sure. IFRS 18 will introduce three sets of new requirements. The first set of requirements creates structure in the statement of profit or loss by requiring companies to present two new defined subtotals. This will provide a consistent and comprehensive starting point for investors' analysis and help investors compare performance between companies, in particular using the operating profit subtotal, which will now be defined and therefore more comparable. The second set of requirements is that companies will be required to disclose information about some non-GAAP measures in a single note to the financial statements. We call these management-defined performance measures. This will help companies to complement information provided using the new structure for the statement of profit or loss with company-specific information about performance and provide investors with greater transparency about those measures. The third set of requirements enhances guidance on grouping of information, also known as aggregation and disaggregation in the financial statements. This will help ensure that investors receive material information, making financial statements more understandable and more useful.
Together, these three sets of requirements will provide better information for better decisions by increasing the comparability, transparency, and usefulness of information. The ISB is preparing for the launch of IFRS 18 in April 2024. The effective date for IFRS 18 will be 1 January 2027, giving companies sufficient time to prepare. There is an option for companies to apply earlier.
Juliana, so that our stakeholders can start preparing, should we take a closer look at each of the new requirements and the reasons the ISB is introducing them?
Sure. The first set of requirements relates to categories and subtotals in the statement of profit or loss. It responds to investors' concerns about the difficulty in comparing financial performance because companies' statement of profit or loss vary in content and structure. For example, operating profit is one of the most frequently used subtotals today, but until now has not been defined in IFRS accounting standards, resulting in companies applying different definitions to the same subtotal. IFRS 18 introduces, in the statement of profit or loss, three new defined categories to provide a consistent structure of the statement of profit or loss: operating, investing, and financing. And two new required subtotals to enable analysis: operating profit and profit before financing and income taxes. This slide contains an illustration of what a statement of profit or loss would look like for a company applying IFRS 18. The operating category is defined as the default category. The operating category includes anything that does not meet the requirements to be classified in the investing or financing categories. The subtotal operating profit or loss will give a complete picture of a company's operations. All companies will be required to present that subtotal, so it will provide a consistent and comprehensive starting point for investors' analysis. The investing category includes income and expenses from investments accounted for using the equity method, as well as income and expenses from cash and cash equivalents, and other investments that investors analyze separately to a company's operations. The financing category, together with the profit before financing and income taxes subtotal, will allow investors to analyze the performance of a company before the effect of its financing decisions. Operating profit is intended to include income and expenses used in key metrics of operating performance. For companies like banks and insurers that have what the requirements describe as specified main business activity, IFRS 18 includes requirements to classify income and expenses in the operating category that would otherwise be classified in the investing or financing categories. For example, a bank which provides financing as a main business activity would classify interest expenses in operating instead of in financing so that it can present net interest income in the operating category. Likewise, an insurer which invests as a main business activity would classify returns on investments held to service their insurance contract liabilities in operating instead of investing so that they can present net financial result in the operating category.